intelligent, hardworking, and motivated man I have ever met. An investment genius. And trust me, I'm not trying to get brownie points either. I mean it. I mean it. Ladies and gentlemen, I present to you Ralph Nour.
Thank you, Bob, for the introduction. I'm quite honored to be here today. I'm going to start by giving you a bit of an introduction about the company, who we are, some of the services that we provide, and then I'll walk you through some of the topics that we'll be discussing today. So I'm just going to go ahead and share my screen. So Nour Private Wealth, we are an independent wealth management company. We specialize in tax, retirement, and estate planning. As Bob mentioned, it's founded by Nour, one of Canada's top 50 advisors for the past 9 years now. We have clients all over the country. We even have clients overseas. Our main office is in Toronto. We have another building in Montreal. We are expanding to US and Dubai in the next 12 months. In 2015, the Financial Advisors Association of Canada awarded us the best new practice at the WP Gala. And in terms of recognition, I would say in 2018, I was also recognized as one of Canada's young guns. Now, what sets Nour Private Wealth apart from the competition? Well, since we're independent, one of the advantages would be the fact that we have access to all the investment vehicles out there, which means that we have access to mutual funds that RBC can offer, TD can offer. We have access to ETFs, bonds, stocks. We even have access to certain vehicles that are only used by pension plans like CPP, OMERS. They use public and private investments. So this is also one of the advantages that we have over the competition. In terms of resources, we work with a big team of tax lawyers, accountants, mortgage specialists, and insurance brokers that we bring to the table whenever need be, keeping in mind that every person's situation is unique, and we want to make sure that we're covering every aspect of their financial plan. Our approach mainly is to treat every case or every customer in a unique way by custom making the portfolio and the plan. We put a huge emphasis on minimizing the taxes that they pay on an annual basis. And in terms of the investments, we are quite conservative in the way we manage. Now, conservative doesn't mean we don't make money. Conservative means that we don't speculate, we don't day trade. Our clients are either business owners, people that are about to retire or are retired, people that really have worked hard to put this money aside. So the goal here is to preserve what they have, get them the best returns, but at acceptable levels of risk. So really the focus is on consistency and a disciplined way of investing. Now we're going to go over some of the topics today. What's the difference between the bank branches and the brokerages? Why should I invest? What should I know before investing? Why should I seek advice? What are the different options for personal investing? The differences between an RSP and a TFSA and the benefits of each, and the future opportunities in finance. So in Canada, there's 6 big banks. Every bank is divided into 2 divisions. You have the branch of the bank and you have the brokerage. Now, we all need the banks. I mean, obviously we have our mortgages, we have our credit cards with the bank. Most people also have their investments with the bank. Now, the difference between TD Canada Trust and TD Wealth would be the fact that really what you can buy from these banks in terms of investments are only proprietary products, which means mutual funds of that specific banks, right? So the people at the bank, it's not like they don't have your best interest at heart. They're really restricted on what they can recommend, right? So if I walked into the bank and I wanted them to buy me a stock, since they're MFDA approved, MFDA licensed, which means their license would only allow them to sell mutual funds, that puts them at a disadvantage over the brokerages. Now, TD Wealth, a separate division of TD, they would have access, they are IROC licensed, which allows them to buy ETFs, stocks, mutual funds. It would also allow them to buy mutual funds from different banks. As you can see here, TD, RBC, Sun Life. However, they do have a certain minimum. And that minimum typically is $1 million. So you would have to have $1 million portfolio to benefit from what I would say better advice or a more variety of products. As for Nour Private Wealth,
you're muted, Ralph.
I apologize.
You
So
just-
Nour Private Wealth. Sorry, go ahead. Sorry.
No, that you're picking up at the right spot, but you're just about to talk about Nour Private Wealth.
So Nour Private Wealth, we're similar to TD Wealth in the sense that we are a full service brokerage. We can offer stocks, bonds, mutual funds, ETFs, whatever's available in the market. But we can also offer additional products like IPOs, like private debt, private equity. Now, keeping in mind that CPP manages $500 billion and 24% of the CPP's money is invested in private equity. 6% is invested in private debt. So obviously big pension plans, there's a reasoning behind that, right? And it's because these asset classes not only provide risk-adjusted returns, but they also lower the volatility in the portfolio and allow the portfolio managers to diversify. Now, in terms of access, we have access to 30 different currencies. As an example, if I have a client that has a pension in British pounds and he would like to transfer it, I can also keep it in British pounds and invest it as is. Clients, we can take clients from overseas. As an example, I have a client that's based in Lebanon. So really, we're not restricted by any means. We get paid on the assets that we manage. So our clients' interests and our interests, they're aligned. If we lose them as a client, we lose a big chunk of our income. Now I'm going to start talking about the different products that are available out there. This is, I mean, I would say this is the most basic one, a GIC. Most people invest in GICs because they think that GIC is safe, right? Now, inflation today in Canada, they're saying it's around 1.8%. I would say it's a bit more than that. And given that the Bank of Canada and the Federal Reserve has printed so much money, this is obviously causing inflation to go up. And I wouldn't be surprised if inflation is at 3% in a year or two. Now, a GIC, it is safe, but I consider a GIC a wealth killer, right? If your money is growing at 1%, inflation is growing at 2 or 3%, you're really losing money by holding onto just cash or a GIC. That's aside from the fact that that 1% you get from a GIC might be taxed. So your rate of return would be cut in half, right? So GICs, I would say it's convenient or it's a good fit to someone that is looking to park money for a few months. as an example, I have a client that's looking to buy another house, and he doesn't want any volatility. He doesn't want anything to cause a drop in his capital. So that's where a GIC might fit in a scenario like that. Mutual funds. Mutual funds, they're actively managed products. Mutual funds are really baskets, right? So the basket can be a basket of stocks, it can be a basket of bonds, or it can be a basket of a combination, a balance of fixed income and equities. Now, because this fund is actively managed, there's an MER tied to it, which is a management expense ratio. Now, if you're wondering where do they come up with this management expense ratio, every fund has portfolio managers, they have analysts, they have traders, and there's the cost to trade. So the MER is composed of multiple factors. Now there's I would say, a bad reputation for mutual funds, or there has been a bad reputation in the past few years, given that there's so many mutual funds in the market. And I would say 90% of these mutual funds underperform the benchmark. So most clients start questioning, okay, so why am I paying an MER to underperform the benchmark? However, there's still that 10% of mutual funds that have consistently outperformed. And that's really why you need an advisor to shop around to find the best investment money can buy. However, unfortunately, because most people are only limited to mutual funds of a specific bank, they've received some bad reputation. Now, keeping in mind that these mutual funds, they can be invested in Canada, they can be invested in the US, it can be a global equity fund. Same thing with the fixed income. It can be global bonds, it can be only Canadian bonds. And this doesn't mean that you have to invest in US dollars to take advantage of US equity. It is a Canadian structured mutual fund that invests in US stocks. We'll go to the next slide, ETFs. Now, keeping in mind that stocks, mutual funds, private debt, private equity, all these are really tools at the end of the day that you can use to custom make a portfolio. So going back to ETFs, there's two types of ETFs. There's active and there's passive ETFs. Now, passive ETFs, they mimic the index, right? They mimic most indices, which means that really you go up and down with the market, right? They're not actively managed. Because they're not actively managed, the fee is usually quite low. Some ETFs, the MER is 0.1%. So really you're barely paying any fees, but in terms of performance, it's always going to mimic the market. There are some actively managed ETFs. These actively managed ETFs, they're similar to mutual funds in the sense that they're actively managed. The difference between them would be the cost and the way they're traded. ETFs are typically traded like stocks, which would be traded on the spot. Mutual funds, they take a few days to settle. Now going deeper into the ETFs can be used in different ways, right? It can be either used as a broad asset allocation, can be used to diversify. You can even include mutual funds and passive ETFs in the portfolio, blend them. You can even use them to fill in any gaps in your portfolio. And maybe I should just give you an example of what I mean by gaps. Given that mutual funds are actively managed, as an advisor like myself, If I want to get a concentration in a specific sector, I cannot do that through a mutual fund, given that the decisions are made by the portfolio manager. So these ETFs, I can give you an example of maybe back in 2019, we started seeing that the market, we had concerns that we've been in the longest bull market in US history. Markets were doing extremely well. We wanted to start shifting into more safety. Now, one of the asset classes we use for safety, or one of the tools that can be used as safety would be gold. Gold has always shown to be a store of wealth, a great hedge against a market correction. So I wanted to take a position in gold for my clients. However, I cannot do that in a mutual fund. I had to do it through buying an ETF. So that's when I took a position in gold, I would say mid-2019. It fared well for me. And I would say I sold my position in gold back in 2020 when I've made a decent profit. And I said, you know what, it played a good role in my portfolio. It's time to utilize this to buy something that might have dropped in value to take advantage. Now, in terms of tax optimization, we know that typically when we sell, let's say, a mutual fund, we cannot buy the mutual fund. We sell it today. We cannot repurchase that mutual fund except after 30 days because it's considered short-term trading. Now, with ETFs, you can always buy a similar ETF that's concentrated in a specific index. So in terms of, let's say, selling at a loss, and you don't want to miss out on the upside, you don't want to wait 30 days to get into the same sector, you can just repurchase that ETF in a different, let's say, fund company. Now, in terms of managing money, we really focus on 4 main points: risk, taxes, fees, and returns. All these points are extremely important, but this is the level of importance. There's no point in me saving clients money in taxes and fees if we're jeopardizing the risk, the capital, which is why risk is extremely important. I'm gonna go over how these asset classes work together to mitigate the risk and how we can use them to our best advantage. Now, most people forget that it's not what you see on the statement as a return that counts. Your net return is a factor of your gross return minus taxes minus fees. So it's extremely important to take taxes into consideration while you're investing. Now, this is a concept portfolio. I'm not saying this is how your portfolio should be by any means, but I use this concept just to simplify the example. So we did mention that gold is a good hedge against market turbulence. Bonds would be also a great hedge. Not any bonds, investment grade bonds to be more specific. They tend to do really well when markets drop. Currencies, same thing. Not any currencies, US dollars, since it's a strong currency, it usually appreciates in a market turmoil. Now, we're going to talk about the relationship of stocks and bonds together, but really bonds, what are they? Bonds are loans. You're lending your money to someone, right? You're lending your money to either the government, the province, or a corporation. Now, governments, you feel safe knowing that obviously if you're lending your money to the government of Canada or the province, they're backed up by federal and provincial assets. So they will never default on giving you back the interest, right? So let's say the government of Canada comes to you and tells you, lend me $1,000, I'll give you back the 1,000 in 10 years. And along the way, I'll give you a 3% interest. So bonds tend to be safe. They're low risk. Not all bonds, again, good quality bonds or government bonds tend to have low risk. Corporate bonds, on the other hand, they go by specific ratings. So the quality of the company determines its rating, how solid it is. So corporate bonds go by AAA, AA, A, triple B, and then it goes down to high yield or junk bonds. Now, anything that's triple B and above is considered to be investment grade or good quality. And that's really what's going to protect you when markets drop. So given the fact that bonds are safe and stocks are really the engine of your portfolio, what you can expect from bonds over the long run is anywhere between 3 to 5%, averaging 4%. Now, in terms of stocks, given that you're taking an additional risk, you can expect an 8% return over 10 years. Now, stocks, there's different types of stocks. You have value stocks, you have growth stocks, you have penny stocks, right? And you also have the size of the company that makes a huge difference. You can invest in larger companies, mid-size, small, or speculative. The higher you go up that ladder, the lower the risk, right? As an example, last year, you're not concerned whether RBC is going to go bankrupt, but you might be concerned if a startup company might have issues, given that business is not as usual, right? So again, we'll get into more depth with the stocks and bonds. I'll just give you an idea of the different types of bonds. Now, if you do have a balance, typically you can expect a 6%, but I would say things have changed. And we'll talk about this in some other slides. Now, in terms of bonds, I'll start by giving you an idea of what's the safest thing you can buy would be the bottom line or the bottom of the pyramid, which is Canadian government bonds, investment bonds, investment grade bonds. The more you go up the ladder, the higher the risk. So think about it like you're lending the money to someone. You might get a 20% interest on your money, but at the risk of what? That person might go bankrupt and never give you your capital back, right? You're happy getting that 20% from bonds, but it's not worth it if you're not getting back your capital. So when it comes to money management, in terms of managing risk, personally, if I want to take more risk, I would have a bigger weighting to my equities rather than take a higher risk in my bonds. Bonds I really use them as safety. So if I need the safety, the only thing that will appreciate are these investment good quality bonds. Going back to preferreds or high yield bonds, these will drop with the equity market when we have a downturn in the market. So going back to the previous crashes that happened in history, so this shows you so a correction is typically a drop of anywhere between 10 to 20%. A crash is a drop above that, right? So this graph will show you what happened in the dot-com bubble in 2000 and what happened in the 2008 crisis. So you will see that the S&P 500 dropped by 47 and 55% in both these incidents. And the TSX, which is the Canadian stock market, dropped by 41 and 45%. Now, this is how bonds reacted when that happened. Bonds were up 34, 21% and 35, 31%. So this is proof to you that bonds really do well when markets drop. Now, why do they do well? I mean, if we think about it, I mean, bonds give you 3 to 4%. So how are bonds going up by 30%? So keeping in mind that bonds, unlike GICs, it's not just based on the interest. The price of the bond can go up and down. So if you bought the bond at par, which is $1,000, and you held it until par, you're going to get your money back. But the price of the bond can fluctuate. If there's a lot of demand on this bond, then the price of the bond would go up. So even though, as an example, you might be getting 2% from the yield of the bond, because there's so much demand, because people decided to sell and get away from the equity market, the money has to go somewhere. It's not going to be sitting in cash earning nothing. It's going to go to bonds earning 2, 3, 4, 5% returns. Because there's so much demand, you would see a flight to safety where bonds have done extremely well. So this is just to explain to you the relationship between bonds and stocks and why we need to have a combination of both in a portfolio, not only to mitigate the risk, lower the volatility, but also to use to buy back into the market, right? If your bonds are going up by 30%, if you're fully in equity and RBC drops by 20%, TD drops by 20%, you're not going to buy RBC by selling TD, right? It defeats the point. Your hands are tied, so all you can do is sit and wait. Now, when you have another asset class making money, we're going to end up selling some of our bonds and going back to these good quality companies, buying them at a discount. That's the best time to buy, is when we can go shopping, when things are on sale. Stocks, well, I mentioned stocks. You have different types of stocks. You have value stocks, you have growth stocks. Value stocks, they're, I would consider them boring stocks that make money, right? So value stocks would be stocks like RBC, like Enbridge, right? Dividend paying stocks that do really well, and typically they drop less than the markets when markets do crash, like in 08, versus other tech companies that would drop as much as the market. Now, this hasn't been the case in 2020, given the fact that it's a unique year where actually technology or growth stocks have outperformed value. Growth stocks typically are technology stocks or pharmaceutical companies that do not give out a dividend. If you're wondering what's a dividend, think about it like rental income. You own a condo, gives you rental income. You feel good that even if your condo drops in value, you're still getting that rental income. These value stocks, they tend to do well over time, especially companies that can increase their dividends over time, keeping in mind that a high dividend payout is not always the best thing, right? So most people think, okay, let's just buy the company that has the highest dividend. Well, typically that's not what we're looking for, right? We're looking for companies that are cash flow strong, not companies that just have a 20% dividend yield, but they're taking a loan to be able to afford that dividend, right? So a great example would be Vermilion Energy. It's an energy company. If we look at the stock, it was trading at $40 years ago. Today it's trading at $9. Now it has a 14% dividend yield. Most people would be attracted to that, but keeping in mind that it's also the valuation of the stock that counts. It's not just looking at the dividends. So going back to why I'm explaining value and growth, it's because you have to have a combination in your portfolio. Even though NASDAQ or technology has done extremely well for the past 10 years, certain years value would outperform growth. And this is an example would be this year, where value has done really well and the NASDAQ has dropped given the nice run it has had last year. Growth stocks, as I mentioned, they don't pay a dividend because they need the funding to reinvest in their businesses to come up with the new technology, new phone, or pharmaceuticals with the new pill. Now, in terms of how the world is changing, years ago, I mean, people used to invest in railways, invest in technology. Sorry, I meant to say telephone, electricity. As time goes by, it's computers and the internet. Today, we're investing more into blockchain, into AI. The world is changing, and we have to adapt to it, right? So certain companies, like last year, I mean, think about, I would say, dinosaurs in the industry, like companies where their business have not kept up with the changes in the world, right? So AI, we can use it to our advantage. A lot of these companies last year, I mean, I was reading a fun fact about blockchain, and it says that it now takes only 2.2 seconds rather than 7 days to know the source of a box of mangoes, right? So what really blockchain does, it's a system of recording information in a way that makes it difficult to alter with or to cheat the system. So I would say blockchain is something that you have to be part of going forward. Same with robotics, right? I'll mention a lot of these technology companies that we've invested in. One of the companies, it's called App Harvest. They've built high-tech greenhouses that produce 30 times more with less pesticides, and they're more eco-friendly. And that's just because they've incorporated technology, and this goes year long, right? It's not based on the season. So there's a lot of good companies. We've seen it also in batteries, in electric cars. So the world is changing, and you need to adapt. Given the situation, I mean, I've met some clients that have held only bank stocks, and we've noticed that bank stocks have quite underperformed compared to technology for the longest time. Not that I don't like bank stocks, they're great companies, but again, it has to be a combination in your portfolio between value and growth. Now, this gives you an idea of the S&P 500 and how only 5 companies constitute half of the S&P 500. Apple, Amazon, Alphabet, Microsoft, and Facebook. Now, these companies, they're giants, right? Their business model is not limited to just their technology anymore. They're so diverse in their businesses. I've read that Amazon started opening grocery stores, right? Apple might be going into electric cars. So there's these businesses, there's high barriers to entry, right? They're monopolies, and I love monopolies because they're going to continue to do well. And if smaller companies have a good business model, they are starting to take a small chunk of their business, they end up buying it out, similar to Facebook buying Instagram and Snapchat. So this is, again, why I like monopolies. Now, this is just to show you that in certain years, value going back in history would outperform growth. In the past 10 years, it's been growth outperforming value. Last year, I mean, it's quite clear why growth outperformed, simply because COVID happened and we were way more dependent on technology. And that's one sector that did extremely well. Now, given that some of these some of these tech companies are up 100, 200%. It just made sense why some of the money would be rotating back into value. Like I saw Bank of Montreal last year drop by 30%, right? So 30% drop, that's a huge drop. Does it mean Bank of Montreal is ever going to go bankrupt? No, really, it's the panic that caused people to sell, and that creates opportunities for us, right? So that's why we consistently rotate, we consistently actively manage the portfolios. We take profits out, we move into companies that we feel they're just mispriced at the moment, but eventually, once they get back the attention, which they have, and we've noticed these bank stocks are up quite a bit this year and um, have done really well. Now, in terms of how your portfolio should be balanced, typically in the textbooks, we read something it's an equation that says, you know what, it's 100 minus your age. 100 minus your age equal the percentage that you should have in equities. Well, I do not think that's applicable anymore in today's world, because it shouldn't be based on age, right? And I'll give you an example. If two 30-year-olds, one is a business owner, quite established, very successful, making 200K, and there's another 30-year-old making 60K salary, and has not saved as much. Does it mean that they should be both investing the same way? Maybe the person that's making 200K is willing to take a higher risk, given that his surplus would be able to help him in terms of buying back into the equity market as opposed to staying put, right? Or let's say I've had a case where I've met a couple, they're in their 50s, and based on the plan that I built for them, based on their spending, really, based on their spending, they will run out of liquidity. They will run out of liquidity in their 80s. What if they live to 90? What if they live to 100? Right? So given the fact that they're spending more, I'm forced to take more risk today in their 50s to be able to grow their portfolio faster. So they have to absorb more risk or the volatility to be able to meet their retirement goals, which is to maintain their spending habits. Now, if they tell me, Ralph, I'm going to spend less at retirement, then that changes things. But again, the allocation, which means how much equity you have to have versus the safety, obviously it makes a huge difference based on the objective, your goals, your cash flow, your age, your knowledge. But it's also something that the advisor would have to understand your situation and advise on, rather than just walking into the bank and getting that survey that asks you how much are you willing to have in high risk or medium risk. This responsibility shouldn't be on the client. This responsibility should be on the advisor to understand your unique situation and recommend the proper allocation based on your goals and different factors. But obviously, the more risk you take, the higher your return. Now, I like this. I like this graph, or this table, I guess. Back in 1995, if you were invested fully in bonds, you could average 7.5%. Keeping in mind that, I mean, mortgage rates at some point were 15%, right? So things are different. Things are different than they are today. In 2005, you would need 50% in bonds, 50% in equities to get that 7.5%. Today, given that bonds aren't yielding much, you have to take out you have to take way more risk to get that 7.5% return. You have to have maybe 15% in bonds to achieve that same 7.5% return. So it's important to understand that things have changed. You need to be way more diversified. You need to absorb. You have to be able to absorb more risk if you're looking to target that 7.5% return. Now, again, this is a concept. This is how most of the portfolios are managed. Now, this is again a concept. If you notice, we have 30% in US equities, and this is public equities, 15% in international, 10% in Canadian markets, 10% in private debt, 10% in corporate investment grade bonds, 5% in gold, 5% in government bonds, 5% in real estate, 10% in private equity. Now, there's a reason behind this allocation. Now, in terms of, if people are wondering, okay, well, private debt and private equity, even though they've done really well in the past, they are a great asset class to have. Why wouldn't I be investing more into them? Now, keeping in mind that these asset classes, there's advantages and disadvantages. One of the disadvantages would be that they're illiquid. There's usually a redemption period, so your money has to be locked in. The second reason would be that they're only available to accredited investors. Now, what makes a person or a corporation or an entity accredited? The first thing would be you have to have $1 million in liquid investments, or you have to have 5 million in a corp, you have to have an income of 200K or 300K with a spouse. So there's different requirements. So obviously these asset classes, they're not for everyone. But in terms of why, as an example, we have 30% in US, and I'm just going to fast forward here to give you an example. This shows you the breakdown of the market cap in the world. You're going to notice that 34% of the market cap is in the States. 15% is in China. Canada is only 2%. Now, I like Canada, but at the end of the day, what I've noticed in client portfolios or people that I've met is that they're home biased. So, I mean, they like Canada because they understand it. They feel safe. They feel safe owning solid companies like Bell, but they don't feel so good about investing in China because maybe they don't really understand the companies there. But again, given the fact that Canada is a small economy compared to the rest of the world, we only have 3 sectors, right? If we think about it, it's financials, it's energy and commodities. While the States would have a big chunk in healthcare, technology. So again, I mean, when it comes to money management, I put emotions on the side, right? So it's a question of getting the best risk-adjusted return, buying the best investment money can buy. China, I'm a huge fan of China now more than ever. It was the only country to have an economic growth last year. I wouldn't be surprised if China surpasses the US in the next 5 years. Some of these companies are much bigger than in the States, like Alibaba. So we've seen China do really well. They're way more regulated than they were in the past, which is why money is flowing into China. So going back in terms of why we're allocated the way we are, obviously because these companies like Apple, like Microsoft, like Johnson & Johnson, I mean, they're all across the world, right? I mean, most of the revenue is coming from overseas, right? They're not just depending on US consumers. I mean, look at McDonald's, it's in every country. Funny story, if I went to Costa Rica, and it's a It's a third world country where uh, people live day to day. And I've noticed kids that live, I mean, 10 people live in the same household, and kids holding an iPhone that costs $1,000. So this just tells you a lot about consumers, right? And uh, where the money is flowing. So that's again why we're overweight in the US. And looking back just at history, US markets have consistently outperformed Canadian and emerging markets. So it just makes sense why US is such a big um, portion of our portfolios. And I mean, this is the proof is in the pudding. I um, I I took all the indices and I looked for the past 10 years how well they've done. And the first one, which would be the Canadian equity market, the TSX, has averaged 7.7% annually for the past 10 years. S&P 500, 13%. NASDAQ obviously has done the best, 23%. Emerging markets, 12%. MSCI, 12.6%, and the EFI as well, 7.11%. So really, I mean, this just gives you an idea. Now, this does not mean the US we should be fully concentrated in the US. On the contrary, I do believe that this year emerging markets might outperform US markets, just given the fact that we've had a very nice run in the US last year, and there's a lot of potential in emerging markets. Now, this just gives you an idea of what $100,000 would be worth if you invested it, or if you kept it strictly in cash, getting you 0.5% in bonds, in Canadian equities, and US equities. So it shows you for the past 10 years, your 100K would have grown to 109 by being in cash, 155 by being in bonds, 175 by being in Canadian equities, and 367,000 if you were in US equities. Now, let's just take 30 years. So let's say you're invested in 91, your $100,000 would be $1 million in Canadian equities, 1.1, and would be 2.1 million in US equities. Your bonds, I mean, given the fact that you're taking less risk, it would be 768,000. So again, that's the risk return relationship. I'm not saying that everyone should be fully in equities. I'm not saying that everyone should be fully in US equities either. I'm just trying to explain the differences between them, and just in history, based on facts, how certain markets have reacted, how certain asset classes have done compared to others. Now, Warren Buffett is obviously a genius. I like his quote: "Unless you can watch your stock holding decline by 50% without panicking, you should not be in the stock market." Right? So people that invest in a stock, you have to understand that you're investing in the growth of a company. You're a shareholder of the company, so you're interested in growing with the company. You're not buying a stock to sell it tomorrow, right? And most people have that misconception. I'm gonna buy it, sell it in a few months if it drops. Well, markets do drop, and sometimes they drop for no reason. Sometimes they do drop because of the fundamentals, right? But a year like last year, where we've noticed some of the company's fundamentals, even Amazon dropped last year, right? In March at the bottom when COVID hit. If anything, Amazon had one of the best years, right? So and I like another one of his quotes, which is, I'm greedy when everyone is fearful, and I'm fearful when everyone's greedy, right? So the best thing to do is understand what you're investing in so that you're comfortable with the risk. And I'll give you, I would say, an idea. I got a call from a client last year. Some clients were wondering whether we should sell. Now, my advice was to buy more, and I've done that. So clients obviously reach out to us as advisors, because we're the professionals, right? They pay us for a reason. They pay us because we know more than them. They have their own professions. They might be specialists in their own profession, but at the end of the day, they seek advice, and they're willing to listen, obviously, to your recommendation. And the best clients, or the best performing portfolios, were portfolios where clients told me, Ralph, we trust you, do your thing. Clients that hesitate often miss out on the upside, keeping in mind that what I invest in, I never look at small companies that might go bankrupt. I'm not trying to double. I'd rather take a 90% probability of making a 50% rather than a 20% of making 150%. And that's because I'm managing the risk for clients. Now, corrections, they're quite normal. The nice thing about this graph, it shows you the corrections that have happened in the S&P for the past 40 years. The green bars are the green bars show you the performance of the S&P every calendar year, and the gray dots would be the corrections that happen every year. So as an example, let's take 2010. We had a drop of 16%. Now that drop can either be for a few weeks, or it can be for a few months. No one knows, right? No one knows the extent of the drop and how long the drop would be, right? But if you sold here, you would have crystallized your losses just because you're in panic mode. If you kept the portfolio as is from January 1st until December 31st, you would have averaged 13%, right? So corrections, they're normal. The best thing to do is to make sure that you just sit tight, especially if you know what you're investing in, and it's part of investing. So again, no one can predict the markets, when the decline would happen. No one can predict how long, and no one can consistently predict the right time to get in and out. And I'll explain that in the second graph. Now, I had a client that gave me a call last year, and he told me he went through 2008, and we all know that 2008 until markets recouped, it took a while. It took 9 months, right? So imagine you're seeing your $1 million go down to 600K. It's tough. It's tough you can't sleep at night, and it's been months and months, right? So he gave me a call last year, and he told me, Ralph, I need to sell, and I advised against it. And the same client had told me, but I've been through 08, and I know how this goes. I'd rather sell at a drop of 15% because things might drop more, and it might take a long time. COVID, the world is ending, people panic. Now, in his case, or in this case, we've noticed that markets recouped last year within 14 days, from March 23rd to April 6th. It only took 10 days for the markets to go back up 21%. And if we see here at the graph at the top, markets eventually went up by 60%. So that again is proof that we can never know the extent of it or how long it would take to come back up. I guess we're running short of time, so I'm gonna go through these slides. This is again an example why we shouldn't have our emotions take over. If you sold in 2008, if you crystallized your losses and you kept the money in cash, your 100K would be 85K, your bonds would be 135K, and if you had a global balanced portfolio, your 100,000 would be 224,000. So you're always better off staying the course, even though it might be out of your comfort zone. I also met a client in 2018. S&P 500 dropped by 20% from October to December 2018. He sold, he panicked, he sold. He reached out to me in, that's a prospect. He reached out to me in the following year, where in 2019, the best 2 months were January, February, where the markets went up another 10% within 2 months. And he missed out on most of the returns in that year. So this just tells you why you shouldn't time the market. If you're fully invested, your 10,000 would remain 142,000. If you miss 10 best days in the market, and you can never know when the best days and worst days are, your portfolio drops to 61K. And if you really sit and try to time the market, I mean, look at the consequences. So again, it shows you the bull markets, the bear markets, the bull markets. It's just normal to get an expansion of, I would say, 5 years of an expansion after a certain recession. Now we are short in time. I don't know if I should go over this quick example. I do like it. I typically give this exercise for you to understand what it means to be invested long term. So let's just use this as a quick exercise. If you had the option of investing in portfolio A or in portfolio B, which one would you pick given the sequence of returns, right? You're investing for 26 years. These are the returns on the portfolio for the next 26 years. Which portfolio would you choose? Now, most people would tell me, Ralph, I'll choose portfolio B. I see less negatives. I see less red. I'm way better off investing in portfolio B. Now, the answer is whether you invest in portfolio A and B, what I really did is just flip the performance. So if you notice, minus 8.4 is the beginning of the year, the first year. Minus 8.4 would be in year 26, and 1.3, I really just flipped them out. What you're going to notice is that whether you invest in portfolio A or B, at the end of the day, if you invest $500,000, you're going to end up with the same result if you really stay invested. So really, it doesn't matter whether you lose money at the beginning or you lose money. You're always going to have good markets and bad markets. Where does it make a difference? It makes a huge difference when you're retired and you're withdrawing from your funds, because if you have bad years and you're at the beginning of your retirement and you're withdrawing from these funds, you're really dipping into your capital, right? When you're dipping into your capital, obviously the consequences of that in portfolio A, what you would leave for your beneficiaries at the estate out of your $500,000 is, I mean, it's close to 19K. And in the second scenario, you would still leave 2.5 million to the estate. Right? So it does make a difference at retirement. However, for younger students who are investing long-term for the next 30 years, it really doesn't make a difference, which means that you're better off investing in equities over the long run, you're going to grow your portfolio faster and reassess, right? Your portfolio should always be reassessed over time. What you invested in 5 years ago or 10 years ago might not be a good investment today, right? Things change. You have to make sure that you're adapting. Now, life transitions, obviously at the beginning, we're building our career. You get a kid, you have to buy a house. As times go by, you start focusing on your kid's education. Then it's really building phase, right? Most of my clients build their bulk of their liquidity between the age of 50 and 65. The reason why is because their kids are independent, the mortgage is paid off, they're in the highest earning years. So they have the next 15 years to build that egg nest, right? So it's only normal that you're saving way more between the age of 50 to 65. And then obviously it's retirement, and then caregiving, and then you're focusing on your estate. Now, having said that, since we do have some students in this webinar, this is one of my favorites. This is one of my favorite slides. The first investor A, is 25 years old, and he's saving $100 a month. He's getting a 6%, he or she is getting a 6% return for the next 40 years. Because that investor started early, now what he saved to the age of 65 is 48,000 in capital, in his own capital, and another 151,000 in interest, compounding interest, right? So this is scenario A, right? This is investor A. Investor B only started saving at the age of 45. He did save double, right? So he's catching up. He saved double for the next 20 years. So really, by the age of 65, investor A and investor B, they've both saved 48,000. However, because investor A started earlier, what he's accumulated in interest is 151,000 versus the 44K, which is why I advise everyone to really start investing as early as possible, even though it's a small amount. It does make a huge difference over time. And it's important to also have goals behind why you're saving, why you're investing, right? When you're younger, you might be wanting, you might be saving for a house, right? So again, where should I save? In which vehicle? Now, I'll briefly talk about the RSP and TFSA. Some vehicles there's always most people ask me, where should I invest, TFSA or RSP? What's a better vehicle to invest in? And the answer is, it depends on a case-by-case basis, right? RSPs, these are both tools or vehicles that the government put in place for us to use to our advantage. Keeping in mind that TFSAs, they're always after-tax dollars, and RSPs, they're there to help you save. I would say you're hitting two birds in one stone, because not only are you saving for your retirement, but you're lowering your taxes. So it wouldn't make much sense for someone that doesn't earn an income or earns 20K in income to invest in an RSP, because you're not getting the benefit of the tax deduction and you're just locking your money in, right? So RSPs make way more sense than TFSAs for people that are earning a good income. Why? Because number one, any dollar that you save today, you're always better off deferring taxes to a later stage, because the value of your dollar is worth way more today than what it will be in 30 years. The second reason would be you're making money, you're getting a rate of return on money that you should have paid in taxes. At the end of the day, it's a case-by-case basis. One of the big benefits of an RSP for maybe the younger generation is that you can use it Most people don't know this, but you can use it for a home buyer's plan, which means to use it as a down payment for a house. You can, not only are you getting the deduction, let's say you started your career, you're young, you just graduated from university, you got a job making 60K, you started contributing. The benefit would be you're saving money in taxes, you're lowering, you're saving for retirement, and you're also using it as a way to put a down payment on a house. So the government says you can take out 35K from your RSPs. You'll have to pay it back over 15 years, but you can use it as a down payment. So this would be, I think, one of the goals for some of the students that are graduating and eventually getting a job and saving. Right? Money is a means to an end. There should be a goal attached to it. Now, in terms of finance, it's a broad field. There's so many different fields you can get into finance, right? You can be I have friends that are investment bankers. I have friends that are traders, bond traders at one of the big banks. I have a friend that is an analyst. I'm an investment advisor. So what's important for you to know is that even though you've all went through a certain degree, education never ends, right? Even myself, every year I have to take courses. The CEO of the company, Ellie, my brother, every year he has to maintain his license. He has to take courses. Same thing with doctors. Right? Continuous education. There's always new things to learn, right? Think about the markets, how they've changed. Think about all these new things like Bitcoin, SPACs. There's always something new. And as advisors, we have to be updated, keep up to date to what's happening. If you're planning on being an analyst, obviously I would say focus on getting your CFA. If you're planning on being an accountant, focus on getting your CPA. If you're planning on being a portfolio manager, CIM, a financial planner, CFP or PFP. So at the end of the day, really, you have to find what you're passionate about. And I would say you have to continue working even after you graduate on getting more degrees. And that's, I would say, I should sum it up, given the fact that we're past 8 p.m. Thank you so much for your attention. I guess we should start the Q&A and take it from there.
Thank you very much, Ralph. That is for an excellent presentation. And we passed the 8 o'clock mark by 10 minutes. I don't know if we can add a few minutes for questions. I see there are no questions in the chat already. I would like to ask you a very quick question, Ralph. Would you advise that in times of market corrections, particularly, would you advise that buy and hold is a better strategy than hit and run?
Buy and hold would be always the best way. What's even a better way would be shifting and buying even more, right? So buy and hold is important. I would say buying good companies at a discount is even better, which is why we've seen some of these companies that we've bought. I would say March of 2020, markets crashed. I sold my gold. I sold some of my fixed income. I jumped into technology. Some of these technology products are up 100% since we've bought them. Some of the companies I've bought, like Etsy, is up 400%. So there's a lot of companies that did well, keeping in mind that it's important not to just, because we don't know the extent of the drop, it's important to gradually go back into the market and not just shift half of your money and just drop it into the market. So I would say March, I shifted my fixed income. I bought into technology. Then April, we've noticed that oil prices went negative, and this was the first time in history that oil prices went negative. Now, logically speaking, we're always going to need, to a certain extent, oil. We're still depending on it. We know that things will change in the future, but when there's mispricing in the market, that's exactly the best time to jump in. So we bought some good companies, and then we noticed that China, given the fact that they've dealt with COVID, they were the first country to deal with it. I jumped into China, buying Chinese companies in May. That was an excellent trade, given that these products were up 40% from the bottom. And then I looked back into my portfolio, and I noticed that technology had a great run. The oil stocks are back up. Everything seems expensive. So the only thing that I could look and justify would be companies that no one's looking at, which are mainly banks. Banks were down 20-30%. I looked at them in September, giving an 8 to 10% dividend. So which means that they're giving an 8% dividend, and there's a big potential on the upside. So it just made sense to me. And then back in now in the new year, 2021, obviously we reshuffled things, we moved, we shifted, we locked in some profits. And that's the same process it's been for a decade. I get excited. Most people panic. I get excited when markets crash. Right? That's how it should be, especially when you know what you're buying.
That's it. Ralph, we're trying to go until 8:20. If the audience allows that. If there is another question, I don't see any hands, but I continue asking you. By the way, for everybody listening, if you want to get in touch with Ralph, you can contact us here at the School of Business. We will connect you with Ralph. And another question is that, Ralph, what, according to you and your company, what is the future of cryptocurrencies?
That's an excellent question, and I ask myself every day. Let's face it. I mean, I look at banks. Eventually, everything, all the currencies in the world are going to be digitalized, right? I think that we would have a digital wallet at the same bank that we deal with, right? No one's going to hold cash anymore, and I think it's a good thing, right? It avoids money laundering. Cash itself is dirty, right? I don't know about germs, but I personally don't like holding cash. But in terms of cryptocurrencies, I have difficulty absorbing or saying, or I mean, at the end of the day, governments, their power is in their currencies, right? So they will never let another currency take over, right? In a sense. So even though they're popular today, they're not going to be a replacement for government currencies. And keeping in mind that they're not regulated, right? So going back to Bitcoins, I mean, there's no intrinsic value, right? Their volatility does not allow them to be a means of trade, right? At the same time, they're not a store of wealth, and they're not backed up by anything. And if someone really hacks you, there's no one regulating it. There's no police that you can go to say, you know what, someone stole my Bitcoin, I'm down 200K, right? So obviously cryptocurrencies are going to have an impact in the future, but I wouldn't think that Bitcoin would be a replacement for government currencies. I think Bitcoin did get attention a lot, and now more than ever, from, as an example, Elon Musk, given that he accepts Bitcoins now, right? So certain things like that just gives more confidence to people to invest in it. Long story short, I would say it's like blackjack, right? You bet on black, either it goes up or it goes down. No one knows with Bitcoin. But at the end of the day, there's a lot of people that made money. I mean, if you've invested $10,000 in Bitcoin 5 years ago, your 10,000 would be worth $1.2 million. If you've done that, I mean, great. The people that made money are the people that actually just sold it, right? That's the only people that make money is when they sell. That's when it counts. But if I'm looking at what's going to happen in the next 6 months to a year, honestly, I don't have a crystal ball, and I don't feel good about it, given that there's no regulation behind it.
Right. The last question, we have 1 more minute for you, is that, Ralph, you alluded to the fact that governments have been printing money all over the place, which is, in economic terms, is a destruction of money, which may well lead to government bankruptcy. So if the governments are going bankrupt in deep debt like that, without any end in sight, would we continue to trust in the currency they issue in the market?
That's a great question. Right, there's a lot of talks of having a global currency, right? There's a lot of talks of having a universal income. There's so many in the future. There's so many things that if you think about, you're scared because you don't know, right? I mean, so many governments went bankrupt, right? Look at Argentina, defaulted on their government bonds. We look at Turkey a few days ago, their currency tanked. Lebanon, another country that's 90% devaluation in currency. And I look at all these governments and they're in debt, but who do they owe this money for? So it's, I mean, I'm looking at the States. Typically when governments print money, it devalues the currency. Now, when everyone prints money, then it kind of doesn't count. But at the same time, I mean, this has consequences. So far, they've done an amazing job in terms of, I mean, with what we've seen, how the dip, it only took 14 days for the markets to go up and for people to feel reassured. And at least today, people are in a better situation than they were in 2009, right? When they're losing their job, they're losing their houses. At least they're getting some money from the government. But this has consequences, and one of the consequences would be inflation. We've seen it in the housing. I don't know about Alberta, but I know that Toronto, it's impossible for the new generation to own by themselves. They do need help from their parents. So this, I mean, going back to currencies, there should be regulation for us to have more confidence. But who knows? I mean, anything's possible. Really, anything is possible.
So again, Ralph, on behalf of Birmingham University and the School of Business here on campus, I thank you very much. I can't wait to see when the COVID time restrictions are going to be lifted to bring you on campus here for direct interactions with the community on campus. And once again, inviting anyone who, if you have any personal questions, you want to connect with Ralph, you can contact us here at business reception at birminghamu.ca, and we will forward your questions and your contact information, or provide you with Ralph information as well if you want that. So again, thank you so much on behalf of all students and faculty and at Birmingham University. We hope to see you on campus one day, maybe next year.
Thank you so much. Thank you for having me.
Okay. Thank you,
okay,
everybody.
Have a good night.
Thank you, everybody, and have a good night. So, did you, oops.
I think we'll just end.